going to talk today about Roth IRAs and Roth conversions. My name is Larissa Greene. I'm with Advanta IRA. I'm so happy to have everybody joining us today. Just a couple of things so everybody is aware. These slides are available as handouts in your control panel. So if you look over to the control panel, you'll see there is a spot for handouts and Roth IRAs and Roth conversions. The slides are attached there. If you have trouble downloading, no problem. Email me after the webinar and I'll make sure that you get them. We're going to talk very specifically today about Roth IRAs. That is going to involve some talk about traditional IRAs as well, because we're going to talk about how to get traditional or pre-tax funds over to a Roth IRA and also how to contribute to a Roth IRA. So it's going to be a great webinar. We talked a couple of weeks ago about Roth conversions and mega Roth contributions to a 401k. So we thought we would also talk a little bit about this because not everybody is eligible for a solo 401k. So we wanted to talk about how to get tax-free growth when you're employed, like as I am with I'm a W-2 employee of Advanta IRA, and so I'm not eligible for a solo 401k. So I wanted to talk specifically about Roth IRAs and Roth conversions so that you can understand how you can get tax-free growth in these accounts. My name again is Larissa Greene. I've been with Advanta since 2011. Over the course of my time with Advanta, I have done all different types of things for the company, including opening new accounts, transfers, helping clients make investments, receiving checks, and whether they're for the payoff of an investment or income on an investment. I have done all manner of things, and I've been doing business development, education, and marketing since probably about 2013, I would say. So I've been teaching classes like this and out and about in my community, teaching classes and also attending different events. If you're on our webinar today and you've seen me out and about, you know I do a lot of networking for the company. So thank you again for joining me. If you have questions today, I'd love to have your questions. Just go ahead and type them into the question box. We're going to keep the webinar muted throughout so that we have a nice clean recording that you can review later, but I will address any questions as they come in. So we're going to talk today about Roth IRAs and Roth conversions, and we're going to talk about how conversions will potentially affect you in your taxes when you do those conversions. But something that we don't do is give any tax, legal, or investment advice. So if you say, how are Roth conversions treated for tax purposes, I can tell you that, I can answer that question. But if you ask me how it's going to affect you specifically, I'm going to actually go ahead and have you check in with your CPA or tax professional, because that is a very specific personal question that they can help you with and not something that I can help you with. So anytime you're making an investment, make sure that you're comfortable with that investment, you're doing your own due diligence, and you're working with your professional team like your attorney when making those investments. Advanta IRA is a self-directed IRA administrator. So what we do is we handle accounts, IRAs, HSAs, ESAs, and solo 401ks that hold private investments. So we're not competing with brokerage firms. We simply hold the accounts. Our clients are finding the investments outside of the stock market, and then we're helping them make those investments in the name of the retirement account. We're not really going to talk about that today. We're really going to focus on Roth IRAs and Roth conversions. But if you have any questions on self-directed retirement accounts, please feel free to check out our video library. Search us on YouTube. We have a lot of webinars where we discuss different investments you can make with a self-directed IRA, the rules involved for making those investments, as well as unique structures that we've seen and our time helping clients make those investments. So remember, we don't sell anything at all. We provide a service, and we can help people nationwide and even worldwide. So we have clients that have US-based retirement accounts that might not be located in the US that are self-directing their accounts. We have over $2 billion in assets under management, and we have basically 2 offices. We're here, our corporate office is in the Tampa Bay area of Florida, and we also have an office in Atlanta, Georgia, but again, we can help anyone, anywhere. Okay, so we're going to talk a little bit about the history of Roth IRAs, and this actually also goes hand in hand with the history of self-directed IRAs. So in 1974, traditional IRAs were created, and one of the biggest questions that I get on self-directed IRAs and private investments within an IRA is, when did this start? When did this start being allowed? It must be brand new, because people haven't heard of things like buying real estate in an IRA, for example, or actually holding physical gold and silver bars, making investments into things like agriculture and local community startups and things of that nature. Typically, people think that this is a brand new idea, but actually in 1974, when traditional IRAs were created under ERISA, you have always been allowed since then to self-direct your IRA. And so when traditional IRAs were created, the purpose for creating those plans was simply to allow people not covered by an employer plan to contribute and save for retirement. So 1974, that's what happened. In 1981, they expanded eligibility for traditional IRAs. So even if you were covered by an employer plan, you could then start contributing also to a traditional IRA. In 1986, deductibility for traditional IRAs changed based on whether or not you are covered by an employer plan, or if your spouse is covered by an employer plan, and that is still in place today. In 1997, Roth IRAs were created, so they come on scene in 1997 to allow individuals covered under the employer plan to still contribute to and benefit from IRAs, since there is no deduction based on the 1986 change. And then in 2006, the Roth 401k was created. So I know a lot of people have heard that term before. You could previously contribute to a 401k, but it would all be considered pre-tax. In 2006, they created the Roth portion of a 401k. And I get this question a lot too. Well, Roth contributions are allowed. Yes, they're allowed by the IRS. You can make Roth contributions to a 401k. However, your plan also has to allow it. So that is very specific as well. If you have a solo 401k with Advanta, you know our plan does allow Roth contributions and Roth conversions. If you have a 401k with an employer, you want to check to see if that plan allows Roth contributions. So we're going to talk again a little bit about traditional IRAs, because that is going to bring us up to Roth conversions. So just so you're aware, anyone with earned income is eligible to contribute to a traditional IRA. Remember, there's going to be some deductibility issues depending on your annual income, but as long as you have earned income, and remember specifically earned income, so passive income does not apply or count here. If you have earned income, then you can contribute to a traditional IRA. Your contribution is going to be limited either to the amount you earn or the maximum of $6,500 or $7,500 annually if you're over the age of 50. So $6,500 if you're under 50, and you have to have at least that in earned income in order to contribute that amount. If you only had $2,000 in earned income this year, then that would be the max you can contribute, for example. The benefits would be that you would typically get that tax deduction. We're going to talk about where those phase outs or your income is going to affect that contribution. It's tax deferred growth. So basically you're not paying taxes on the seed, but you'll pay taxes on the tree at retirement based on your distributions. You can roll old employer plans into a traditional IRA with no tax consequences. So a lot of times that's a question we get with a self-directed IRA. Can I take my TSP? Can I take my 457 or my 403 plan and move it into a traditional IRA? I don't want to pay taxes. And the answer is yes. If your plan is made up of all pre-tax dollars, then it can go into a traditional IRA seamlessly without paying taxes or penalties. And now you're saving for retirement. That's the biggest thing. And most important thing here is that you're saving for retirement when you make those contributions. So a lot of times people will say to me, well, I'm this age, I haven't started saving. What would be the benefit? The benefit simply is saving for retirement. So there are deductibility phase out limits for traditional IRAs. And those phase outs come into play if you or your spouse contribute to an employer plan. So if you are a W-2 employee like I am, and you participate in a 401k, a 457, a TSP plan, and you earn a certain amount, you're going to lose some or all of your deductibility with a traditional IRA, and I have laid them out for you here. These deductibility limits change every year. If you don't participate in a 401k or an employer plan, but your spouse does, that is also going to limit your deductibility. And so you can see that also here. And if you have more questions on that, let me know. But basically, we're looking at your annual income. And for 2023, and again, if you or your spouse is covered by an employer plan, then there's going to be some phase out limits for the deductibility. So, and what I mean by that is that if you make a contribution to a traditional IRA, you're typically going to get a deduction on your taxes. But if you are covered by an employer plan or your spouse's and you make a certain amount, then your deductibility is going to be 0 to limited based on how much you make. Traditional IRAs, how do distributions work with traditional IRAs? Well, remember we talked about how you're going to get a deduction and then it's going to grow tax deferred. What that means is eventually the IRS is going to ask for some taxable income so that you pay taxes on the amount that you're saving. So how does that work? There is an early withdrawal penalty if you're under age 59 and a half and you take a distribution. So if you're taking money out before what the IRS considers retirement age of 59 and a half, you're going to have a 10% early withdrawal penalty. And that's very important to understand. So when you put money in, you can't just immediately take it back out, or you can, but you're going to have this 10% penalty. It's taxed at ordinary income after 59 and a half. So if you've reached age 59 and a half and you would like to take a distribution, it's just simply taxed as ordinary income. How does that work? Well, it is a 1099 to you at the end of the year. So when you go to prepare your taxes, if you took a traditional IRA distribution, then you're going to get a 1099 and you're going to take that to your tax professional to help them help you file the 1099 and pay the taxes owed for the amount distributed. You can also ask your custodian or third-party administrator to withhold some of those taxes when you take a distribution. At age 72 or 73, if you reached age 72 after December 31st of 2022, required minimum distributions start, and they must be taken each year once you reach that age. So you do have to take a distribution again so that the IRS can get some of that tax revenue from the income on that growth. And so that distribution is going to be a calculation based on your life expectancy and the amount of money you have in that account. It's recalculated every year, and the calculation is based on the previous year's December 31st value. There are some exceptions to the 10% penalty: higher education expenses, disability, first-time home buyer, and inherited IRAs. Rules of inherited IRAs have changed. And so we actually did a whole webinar on the rules for inherited IRAs, but very quickly, if you're a spouse and you inherit an IRA from your deceased spouse, then you can treat it as your own. So you could literally open an IRA in your name and move it over, and now it's your own IRA. If it is a non-spouse beneficiary, then the whole account must be distributed within 10 years. And there are some few exceptions to that rule as well. And again, I would encourage you, if you have questions on that, to listen to our webinar on inherited IRAs. I had a question pop up on an RMD. What is an RMD? An RMD is a required minimum distribution, meaning that once you reach age 72 or 73, depending on when you reach that age, you will be required to take a distribution from a pre-tax account like a traditional IRA. So basically, you've been growing it tax deferred all these years, and the IRS says, well, we want some tax revenue, so we're going to force you to take a distribution once you reach this required minimum distribution age every year, so that you're paying tax revenue on that retirement account. So sometimes people don't need to take distributions, and so they want it to continue to grow tax deferred, but the IRS is going to say, well, you have to take a minimum distribution once you reach this age. So now we're going to talk about a Roth IRA. And this year, the contribution limit for a Roth IRA is going to be $6,500, just like a traditional IRA, or $7,500 if you are over the age of 50. So you get that catch-up contribution if you're over the age of 50. You can contribute $6,500 or $7,500 either to a Roth or a traditional, or a combination of the two, but it is not $6,500 each, a traditional and a Roth. It's $6,500 total per individual. So you can choose to contribute either to a Roth or a traditional or a combination of the two, but the total contributions cannot exceed 6,500 or 7,500 total for the year, and that's for 2023. And occasionally it does go up, which it did go up for 2023, and it was brought up to that 6,500. I had a question pop up. Do RMDs apply to both a Roth and a traditional? No, they only apply to a traditional or pre-tax account. So traditional IRAs, 401ks that have traditional funds, that actually changed this year. So it'll be interesting to see how they treat that, because it is technically right now traditional and Roth monies in a 401k that are subject to the RMDs, but they changed that this year, and we'll get more information as the year goes on as to how that's going to be treated. But a Roth IRA does not have a required minimum distribution. So that is a benefit of a Roth IRA. So you can see that in my second bullet point here under benefits. No mandatory withdrawals, or of course we're talking about RMDs, required minimum distributions there. Anyone with earned income can contribute to a Roth IRA as long as their modified adjusted gross income does not exceed a certain amount based on their filing status. And I have that coming up for you. So you can contribute to a Roth IRA as long as you have earned income and as long as your income does not exceed a certain amount. You have tax-free earnings, but you don't get your deduction. So if you were getting a deduction for your traditional IRA contributions, you are not going to get them for the Roth contributions. The benefit here, of course, is that you're paying taxes on the seed and not on the tree at retirement. And where does it make sense to have a Roth IRA? Well, it depends. It's a personal decision, but you may be in a lower tax situation this year, but expect to pay higher taxes in the future on your income. And so maybe that is a benefit to the Roth IRA for you. If you can't contribute to a Roth IRA directly because of your income levels, you can contribute to a traditional and then convert to a Roth, and that is a backdoor Roth IRA, which I discussed a couple of weeks ago in our webinar. So if you have questions on that, reach out to me and I can help you get a link to the recording for Roth backdoor contribution. So here is the modified adjusted gross income levels for Roth IRA contributions. So at what income level are you, and whether you'll be able to contribute directly to a Roth IRA, or if you want tax-free growth, again, going back to that backdoor Roth contribution. So between $218,000 and $228,000 if you're married filing jointly. If you make $218,000, then you're going to get some prorated contribution allowed to the Roth IRA directly, and then it's going to be no Roth contribution at above $228,000. If you're married filing separate, it's less than $10,000 of income, and then single, head of household, or married filing separately, with the caveat that you did not live with your spouse at any time during the year, is $138,000 to $153,000. So you can see that there as well. So, and this, again, this is changed every year. So if you make too much to contribute to the Roth IRA based on this information, you're going to want to check this every year. Roth IRA distributions. There is a 10% penalty if you withdraw earnings before 59.5. So I really should have specified here earnings, because we're going to talk about how contribution distributions work in just a second. But if you try to distribute more than the contributions you've made over time, then a 10% early withdrawal penalty will apply for any earnings before 59.5. This does not apply to contributions. So if I've contributed over the course of, say, 5 years, $20,000 to my Roth IRA, I can take up to $20,000 out of the Roth IRA at any time, tax and penalty free. And a lot of times people will see that as a big benefit, because if you had some emergency and you just made your Roth IRA contribution, but you need to distribute it, that can be done tax and penalty free. Tax-free income in the Roth IRA after 59.5, age 59.5, and as long as the Roth IRA has been open for a minimum of 5 years. So both of those things have to be true in order for you to take tax-free distributions of earnings. And there are some more rules that will apply here, and I'll tell you about them in just a minute. A question popped up, is there a limit for traditional IRA to Roth conversion when in retirement? There is no there's no limit to Roth conversion. So the IRS says, sure, go ahead and convert your traditional pre-tax money to the Roth because they want that tax revenue. So you're okay to convert to the Roth IRA at any time. And it doesn't matter if you've reached RMD age. So that was the second half of that question. It doesn't matter your age. You can convert to a Roth at any time, remembering that it is going to be converted at ordinary income. So you're going to get a 1099, and we're going to talk about that in a minute. What if you add to the Roth IRA within the 5 years? Does that start your clock again? It does not. So the clock starts counting with the first, when opening the Roth and making the contribution, and that clock is ticking from the January 1 of that year. So if if you contributed before April 15th this year and made a previous year contribution, then your clock started ticking January 1 of 2022. So you got a year for free in there. So the clock starts ticking January 1, the first year you open and contribute to the Roth IRA. Some exceptions to the 10% penalty of earnings would be higher education, disability, first-time home buyer, and inherited IRAs. And again, that is going to be the same for traditional IRAs. The distributions from Roth IRAs are in a specific order. So this reminds me of order of operations. You remember those rules for math? Well, this is kind of how it works for a Roth IRA. Your contributions are always considered distribution first. So in that same example where I said I contributed $20,000 over the last 5 years and I needed to take a distribution. Well, that $20,000 in contributions is going to be considered distributed first. So when I take a $5,000 distribution, that's going to count towards whatever I contributed. If at some point I distribute $21,000, then $1,000 is going to be considered earnings in this example, and it's going to be subject to tax and penalty. The next order of operations is any conversions that you have done. So if I had 20,000 in contributions and I converted another 10,000 from a traditional IRA, well then if I distribute 21,000, again, same example, 20,000 is going to be considered my contributions to the Roth IRA, and 1,000 would be considered the converted amount. Those additional rules I mentioned above would apply to conversions. Each time you do a conversion, the converted amount is going to have its own 5-year aging. So everybody out there that does conversions over time, they say, I don't want to take that taxable hit all at once. I don't want to take all that money into ordinary income all at once the year I want to do the conversion. So I'm going to convert a little over time. Every year that you do a Roth conversion, that amount converted is going to have its own 5-year aging. And then earnings are considered distributed last. A question popped up, if I have a traditional IRA for 15 years and want to convert it to a Roth, do I still need to wait 5 years? I think I answered that. But if you've never had a Roth IRA and you open and contribute to a Roth IRA directly, it doesn't matter if you've had a traditional, the Roth IRA has its own 5-year aging. If you have a Roth IRA and it's been open for more than 5 years, but you do a conversion, again, it won't matter because unfortunately Roth conversions every time have their own 5-year aging. If you're over 59 and a half, beyond the 5-year point, does the ordering rule still apply? Yes, the ordering rules will still apply. So let's say that I'm 65 and I decide to open a Roth IRA. This is my first Roth IRA ever. Then it still has to age for 5 years in order for the earnings to be completely tax-free. So you want to get that account open and start that clock so that you can take your tax-free distributions of earnings as well. Can I contribute any amount to a non-deductible IRA and convert it to a Roth later? The contribution rules are still going to be in place here. So even if your traditional IRA is not considered deductible, you're still going to be subject to the amount the contribution of the contribution rule. So this year it's 6,500 or 7,500 if you're over the age of 50. Can you move the RMD to from a traditional IRA to a Roth? When you take a required minimum distribution, you have to take that money out of the traditional and it cannot be directly deposited to the Roth. If you had enough earned income that year to contribute to a Roth and you are eligible, you can contribute to the Roth IRA, but it's not going to necessarily be considered your RMD. It's still based on whether or not you have earned income for the year. So I don't know if I explained that very clearly, but ultimately the RMD can't go directly to a Roth and you can't put it into a Roth unless you have earned income and you are eligible. So here's a table kind of giving you an idea of where those, where things are allowed with a traditional IRA versus a Roth IRA. And these check marks are green, but I just want to point out that they're not, positive versus, they're not all positive. They're kind of pros and cons, potentially, depending on what you're looking at. So you're going to get a deduction for making a contribution for either this year or last, depending on the year you're contributing to. For a traditional IRA, most likely. Again, there's going to be that deductibility table that would apply here, but typically you're going to get a deduction for making a contribution to your traditional IRA. You're not going to get a deduction in a Roth IRA. You're going to get tax deferred growth in the traditional and the Roth. It's technically tax free as long as those two rules were true above. So you're 59 and a half and it's aged for 5 years. You have tax-free retirement income with the Roth only. Remember, the traditional is tax deferred. You can make contributions past 72, required minimum distribution age, or 73, depending on when you turn 72. That is actually now true for traditional and Roth IRAs. There was a time where you could no longer contribute if you were over required minimum distribution age with a traditional IRA, but the Secure Act actually changed that of 2019. So you can make contributions to either of these accounts over RMD age as long as you have earned income. You have flexible distributions. That is true for traditional and Roth IRAs. You can take money out of a traditional IRA just like you can a Roth IRA after age 59 and a half, and you can do that when you want to. So if you said, I'm not going to take a distribution this year, but next year I'm going to take a large distribution so I can take that trip to Hawaii I always wanted to do, you can do that. The exception there, of course, is going to be with a pre-tax account or traditional IRA once you reach required minimum distribution age. Increase in net income upon retirement. So you're going to get your distributions from the Roth IRA tax-free. So that applies to the Roth. Income restrictions, that applies to the Roth IRA. You can always contribute to the traditional as long as you have earned income. The deductibility is going to depend on your income, but you can still make that contribution. And then flexible contribution distributions, that only applies to the Roth IRA. So remember, we talked about when you make a contribution to a Roth IRA, you can take that contribution out at any time, tax and penalty free. It is your earnings that are subject to taxes and penalties depending on your eligibility. I had some more questions come up. Give me just a second. Can your RMD from a traditional IRA be used for your Roth contribution? And you're correct. The answer was no. It's technically, when you take the RMD, it can't immediately go into the Roth. You have to make a contribution to the Roth, and as long as you have earned income, you can make that contribution. But if you don't have earned income, then that's just very simply a distribution, and it technically is anyway. The paperwork is going to show it as a distribution, and you would still have to have earned income to contribute to a Roth IRA. Interest and dividend income are not considered earned. Is that correct? That is correct. That would be considered passive income, and the IRS does not consider it earned income for the purposes of contributing to an IRA. What was the part about taxable on the distribution for the Roth IRA? So the Roth IRA income is going to be considered taxable if you are not age 59 and a half and the whole account has not aged for a minimum of 5 years when you take a distribution. So two things have to be true for Roth IRA income to be considered 100% tax-free. You have to reach age 59 and a half and the account must be 5 years old. It must have aged for 5 years. And on Roth conversions, they have their own 5-year aging for earnings to be considered tax-free. So you have to reach age 59 and a half, and you have to have had your account established for 5 years in order for earnings to be considered tax-free. Your Roth conversion earnings have to be 5 years old in order for those to be tax-free independent of the account. What are the restrictions on annual income traditional IRA contributions? So it's the modified adjusted gross income. So I don't know if you were able to download the handout, but if you go back up, you're going to see 2023 IRA, traditional IRA deductibility limits on modified adjusted gross income. And that table will show you. And it's going to depend on your tax filing status. So are you head of household, married filing jointly? Do you and your spouse both have income? And that is all dependent on you or your spouse contributing to an employer plan. So if you're not contributing to an employer plan and your spouse is not contributing to an employer plan, then your traditional IRA contributions are always going to be deductible. So if you can't get those slides, though, go ahead and send me an email and I'll make sure to get them to you. Contributing $6,500 to a deductible and non-deductible IRA the same year, you cannot contribute to both. You have to choose or do some amount to each, but the contributions you make total in a year cannot exceed $6,500. Another question that popped up, do you know if Social Security income is considered earned? I don't believe it is. I get this question a lot and I always forget the answer, so I apologize to that, but I do not believe that it is considered earned income. Another question popped up, is there an income limit to contributions to an employer plan? Technically, there's not an income limit to when you're making contributions to an employer plan, but there is an amount that is limited that you can contribute. And it is it's this year it's 66,000. And if you're under the age of 50, I think it's 50. If you're under the age of 50, you can contribute up to 66,000, but that's a formula of your income. So it's not, oh, well, I make, 300,000 a year, so I can contribute, up to the max, which is potentially true, but it's also based on your earned income. So if you're self-employed and some of that money is considered earned and some of it's considered dividends from your company, then it's going to be based on your earned income. And if, for example, you had 50,000 in earnings this year, you could potentially contribute a lot of that money, but you're not going to be able to max out that 66,000 because you didn't have an earned income. And if you're looking to learn more about the solo 401k and how employer contributions work, please let me know. I'm happy to go over that with you, but you're going to be limited up to 66,000 in a 401k, and that is going to be based on a formula of your income. I hope that answered it. I felt like that was a long way to get to that answer. I had a question on emailing the slides. If you would just send me a quick email, my contact information will be up again at the end of the presentation for you to go ahead and send that email over to me. I'm happy to get those slides to you. You can contribute both to the Roth and traditional portions of the employer plan, and there is no income limit. So thank you for specifying that question. There is no income limit to make Roth contributions to your 401k. So if your 401k allows Roth contributions, regardless of your annual income and whether or not your spouse contributes to an employer plan separately, you can always make your Roth contributions as long as the plan allows it. And this year it's $22,500, and those are currently employee contributions. I know that changed this year with Secure Act 2.0, but we are still waiting for guidance from the IRS as to updating plan documents to allow employer contributions to be Roth as well. Our funds, I had another question pop up, our funds from an external Roth IRA older than 5 years, which used to be separate from Advanta Roth IRA, subject to a new 5-year aging, they are not. So as long as you have a Roth IRA somewhere in existence, then there's only one 5-year aging for opening and contributing to the Roth IRA, again, just remembering that Roth conversions have their own 5-year aging. So if you had a Roth IRA with your brokerage account, your brokerage firm, and it's been open for 15 years, and you open a Roth IRA with Advanta, there's no new 5-year aging. That would not apply. Okay, I think that's all the questions I had for right now. Keep those questions coming. So here is a little bit of information on a question that we get a lot. Will Roth IRAs ever be eliminated? And I know that people with Roth IRAs are very concerned about that because they want to be able to continue to contribute to their Roth IRA, and they don't want it immediately distributed to them if the government ever decided to do away with Roth IRAs. And so here's the way that a Roth IRA contribution versus a traditional IRA contribution affects tax revenue. So, generally, we don't think that they would ever be eliminated, and here's why. If 100 people make a contribution of $5,000 to a traditional IRA, then that results in $500,000 worth of tax deduction. So $500,000 in tax deductions for 100 people making that contribution. If the taxpayer's average tax rate is 20% at retirement, remember we're talking about at retirement again, this results in less than $100,000 in tax revenue in this same, category. When the IRA owner takes distribution, the IRS/government will receive tax revenue on those distributions. The same 100 people make a contribution to a Roth IRA, they do not get a deduction. So they will receive $100,000 in tax revenue now, but no tax revenue in the future. So there's still that tax revenue for the government. It's just now versus later. And so there's a benefit to the IRS for keeping Roth IRAs in place. So they will generate tax revenue now and later, depending on the type of IRA account an individual has. So because they're generating tax revenue regardless, they probably will not do away with Roth IRAs. So Roth conversions defined. Again, if you have questions on making backdoor Roth contributions, I'm happy to send you the link to our webinar on that, again, that I did a couple of weeks ago, and that really will kind of outline the process for that. But I had somebody that joined late ask about the $66,000 limit. I was referring there actually to an employer-based plan, so our solo 401k, but any 401k, the contribution is $66,000. But that is subject to a formula of your income. So if you're a participant in an employer plan, a 401k specifically, then your contribution limit is going to be $66,000. But it is employer and employee contributions, and it is a formula of your income. So if you're self-employed, then you can potentially contribute up to $66,000. But again, it's a formula based on income. Another question popped up, just to confirm, moving a Roth IRA from Fidelity to Advanta, that does not require the 5 years to start again. No, it does not. The 5-year aging only starts again if you do a Roth conversion, and it only applies to the converted amount. Is there a recording available of this webinar? The answer is yes, this is actually being recorded, and you'll get a link to the recording in just a day or so. Once we pull the video and put it together and reformat it, then it will go out to all attendees. So what is a Roth conversion? It's taking an account with pre-tax contributions and earnings, typically a traditional IRA, but it could also be a SEP, a simple, an old 401k, and any type of employer plan with pre-tax money, and moving it to a post-tax account, so a Roth IRA. So you're basically taking that money from pre-tax, you've gotten deductions potentially, it's grown tax deferred over time, and now you're moving it to a tax-free growth account. And so in order to do that, it doesn't just go over there, you have to pay the taxes at the time that you would like to move that money to the post-tax account. And we're talking today about a Roth IRA, but this could also be true for your employer plan if they let you do Roth conversions within the plan. What you're doing is electing to pay the taxes now on funds transferred over rather than have them grow tax deferred, and then they would grow tax deferred within the Roth account. In short, paying the taxes now rather than later and having tax-free growth, again, with those rules that would apply, again, 5-year aging on the conversion. So here are the rules. Roth conversions must be done by December 31st of the tax year you would like to pay the taxes for. It is not April 15th. So there is, that is very specific. That deadline is December 31st. A lot of times people will call us, in March and say, I found out that I had a lot of losses last year, so I'd like to do a Roth conversion for last year. And unfortunately, by then it's too late. So get with your tax professional before December 31st if you're considering a Roth conversion, so you can make sure to understand if this is a good year for you to do the conversion. There's no modified adjusted gross income limit for converting. So regardless of your earnings this year, you can always convert to a Roth IRA. Anyone can do it because remember, that's tax revenue to the IRS. And so they're happy to let you do the Roth conversion so they have more revenue for the year. The fair market value of any conversion is reported to the IRS on a 1099 for the calendar year the conversion is done. So if you convert $50,000 to a Roth IRA this year, that $50,000 is going to be brought into ordinary income for you, and you personally are going to pay the taxes. That's another question we get a lot. People will say, well, whenever I do the conversion, I want the money or the taxes to be taken out of the converted amount. And unfortunately, that is not the way that it works. You could potentially take a distribution of money from the Roth IRA to help you pay the taxes, but if you're thinking about doing that, remember that we do not give tax advice, and so I would strongly urge you to talk to your tax professional before doing something like that. The amount of the conversion is included in your taxable income, and it can bump you into a higher tax bracket. But losses can offset income from the conversion. So if this was a year where you had a lot of losses, then this might be the year that you talk to your tax professional about doing the conversion. And we also talked about how you can convert any amount at any time. And so if you decide that you want to do a Roth conversion and you want to do it slowly over time, you certainly can do that. So if you had $100,000 and you wanted to do it in $20,000 increments, you can do that. But each year that you convert 20,000, that 20,000 is going to have its own 5-year aging. And if your modified adjusted gross income is too high, then you can contribute to a Roth IRA by first contributing to a traditional IRA, i.e. the backdoor Roth contribution. You cannot convert for prior years once December 31st has passed, and you can't go back and convert for years before that either. And that's a question I get a lot. Well, I didn't have a lot of income, and I haven't finished filing my taxes for my business because tax filing deadlines plus extensions can take you well into the next year. Unfortunately, it's too late. It has to be done by December 31st. I had a few questions pop up as we are going along, so let me check out these questions and we'll address some of those. The backdoor Roth conversion, I had somebody ask me about that. Go ahead and send me an email. My contact information, again, will be on the last slide here. Send me an email, remind me what information you're looking for. I'm happy to send you the link to the webinar I did on backdoor Roth conversions a couple of weeks ago. Another question, when I convert to a traditional IRA to a Roth IRA, I'll pay ordinary income taxes on the conversion. Can I use Roth IRA funds to pay that? We talked about that. If you're thinking about doing that, that is a distribution from the Roth IRA, and so you do want to talk to a tax professional about how that will affect because you're going to get issued another 1099 for that distribution, and whether or not or how that's treated for tax purposes is definitely a question for your CPA. So remember, you're going to get a 1099 for the conversion, and then if you take a distribution from your Roth IRA, you're going to get another 1099 for that distribution. So please, please, please talk to your tax professional about that. I had another question pop up, and it seems to be a very specific question. So I'm going to ask you to go ahead and give me a call or send me an email, and we can go over that. So if you have a specific scenario that you would like to address on your own tax brackets and things of that nature, that's going to be a question for your CPA. But if you have a specific scenario on how a conversion will work, I'm happy to answer that, and just make sure to give me a call or send me an email. I had a question on what advantages, apart from tax-free earnings from the conversion, are there for a Roth IRA specifically, how does this apply to an inherited IRA? Well, that's a great question. And I know I did not address that, so thank you for bringing that up. There are advantages to the Roth IRA for your beneficiaries, just like there are for you. So at the time that you convert to the Roth, you're now, you have that 5-year aging on that converted amount. But once that 5 years has passed, if something happens to you, your beneficiaries are going to inherit those funds tax-free. So at the time that your beneficiaries take distributions, and that includes your spouse, they're not going to have, it's not going to be considered taxable or ordinary income to them. If you have a traditional IRA and something happens to you, then at the time that your beneficiaries take distributions, they are going to have that considered ordinary income to them. So thank you for bringing that up. So why convert to a Roth IRA? It could be because you expect larger returns on a specific investment in future years. So you want to pay the taxes now versus later when you realize the income from that investment. You have a long time before you retire. So if you say, you know what, I want to do that conversion, I'm not going to retire for another 25 years. If I pay the taxes now, then when I reach retirement, it's going to be tax-free. You expect to be in a higher tax bracket because maybe rates increase over time, and in the future your traditional IRA contribution was not taxable or non-deductible. So if you make a contribution to your traditional IRA and it's considered non-deductible, you may want to talk to your tax professional about immediately converting that to the Roth, or that's also called a Roth backdoor Roth IRA contribution. Some taxes may still be owed, so there are, specific rules for that traditional IRA contribution. If it's non-deductible, again, talking to your tax professional to understand how that works, and I can also send you my webinar on that. We talk a little bit about that as well. Your assets within the IRA currently have depressed values. So if you have investments within that account and those investment values have gone down, that might be a time to convert. You have losses to offset the income from the Roth conversion. Again, estate planning reasons, so the question I just addressed, or your ability to pay the tax due on the conversion is your income is available to pay the taxes now versus looking at doing it down the line where you may not have the ability to or want to pay the taxes on the conversion later on. Remember, the taxes are not withheld from the conversion. And again, if you're looking at having the Roth IRA pay the taxes, then that would be a distribution from the tax and another 1099. And how that is treated for tax purposes would be a question for your CPA. Why not convert? So we're doing sort of the pros and cons here of doing a Roth conversion. If you're close to retirement and you're not expecting any significant growth in the value of your assets, and you're expecting upon retirement that your taxable income is going to go down, you might not want to convert to a Roth IRA. A lot of times people will say, well, I know the Roth IRA is better because of tax-free growth, but it may not be for everybody. Again, it's specific to your situation, and looking at things like when you plan on retiring and what tax bracket you're going to be at in retirement may have an effect on this decision that you make, because you might be in a lower tax bracket, especially if you're close to retiring once you retire. Your asset values in your IRA are inflated, or you're expecting the values to decrease at a later date. So if you have investments and they seem to be at an inflated value, this may not be the time for you to do the conversion. If you don't have available cash to pay taxes due on the conversion, so I mean, if you do a conversion of $150,000 or $150,000 asset, then that is going to be a 1099 for you in the year you convert of $150,000. So if you're not ready to bring $150,000 into ordinary income, this might not be the time to convert. Or again, you may want to convert a little over time. The income from the conversion may result in a loss of other benefits, child tax credits, Medicare premiums. These are all things to consider when you're looking at a Roth conversion. And you want to access the funds within the next 5 years. Remember that it does have its own 5-year aging, and so you're not going to have access to tax-free earnings if it's within that 5-year period, and potentially other implications there as well. So let me just check on the questions here, and then we're going to talk about converting assets versus cash. And I kind of mentioned that quickly a moment ago. A question did pop up. Do beneficiaries need to have their accounts distributed over 10 years like in a traditional IRA? Yes, that is true. Beneficiaries that inherit an account, whether it's Roth or traditional, will have to distribute over 10 years, and there are a few exceptions to that. One exception being spousal beneficiaries. So if you leave your retirement account to your spouse, they can treat it as their own and they do not need to distribute it over 10 years. And there are a few other exceptions there, but typically non-spousal beneficiaries are going to have to distribute either a Roth or traditional IRA over 10 years. However, or within 10 years, I should say. However, if it's a Roth IRA and it has its proper aging in place, then it's going to be distributed tax-free to your heirs. So how do the Roth conversions work when it is cash? Well, if you convert cash, that's simply the converted amount. So if you convert 150,000, then you're going to get a 1099 for 150,000. But if you're converting an asset, then the converted amount or the 1099 is going to be for the qualified fair market valuation of that asset. So if you own real estate in your IRA, for example, even if you bought it for 150,000, if you didn't buy it within the last 30 days, then it is going to be considered or need to be evaluated by an independent qualified third party. And the amount of the conversion is going to be the amount of the value. And that's very important because if you bought a property 5 years ago for 150,000 and the value now is 350,000 and you want to convert that property to a Roth IRA, then the converted amount is going to be 350,000 and you're going to receive a 1099 at the end of the year for 350,000 that will be brought into ordinary income for you. If you're converting an asset, not only do you need a qualified fair market value from an independent third party, qualified third party, but you're also going to need some documentation in order to help that asset move from your traditional or pre-tax account over to the Roth. So again, if you own real estate, it's not just going to drop into your Roth IRA. You're going to need a deed in order to do that because the holder of that investment is no longer Advanta IRA FBO John Smith IRA 1234. It is now Advanta IRA FBO John Smith Roth IRA number 5678. And so you're going to need the proper documentation in order to show change in ownership for the conversion. So you're going to have your tax professional or maybe your attorney help you with some of this stuff where it could be, again, for property, it would be a deed. If it's a mortgage or a deed of trust, it's going to be an assignment. You have to re-register LLCs and limited partnerships and so on and so forth. So just making sure that you're aware of that documentation. And if you have an asset in your account you would like to do a Roth conversion, please talk to us and we can help you understand what might be needed in order to do that. So the fair market value, as defined by the IRS, is a valuation must be provided by an independent third party who is qualified to value that particular asset being converted. That can be a CPA, an attorney, an appraiser in the case of things like limited partnerships and real estate and things of that nature. So it has to be somebody that is qualified to make that assessment and they have to be considered independent. All valuations must be within a reasonable time. Advanta IRA requires that valuation to be done within 30 days of the planned conversion. And we want to have you sign a form that says that you are agreeing to the value as well as the independent third party. And we do need some backup for that valuation as well. So for real estate, must be valued by an appraiser for the property, and that must be a qualified real estate appraiser. So you'll get that question a lot. For notes, the fair market value of the loan or note would be the outstanding principal balance plus any unpaid interest. That one's pretty easy. That one is not as difficult as some of the other valuations. For LLCs, corporations, and partnerships, if the manager, president, or officer is not qualified or considered independent, then it would be an independent third party, and that could possibly be somebody like your CPA. Or, of course, there are people out there that literally provide valuations of these things, and you can work with them as well. And if you have other assets in your account, some other alternatives here, and you're curious about that, please feel free again to reach out to me, and we can go over what might be required. We kind of talked about the pros and cons, but keeping in mind that everybody's situation is unique. So there's not a right or wrong answer here. It's just whether or not you're ready to bring that amount into ordinary income. And if you want tax-free growth, again, depending on your age, the projected returns, how close you are to retirement, and making sure that you're talking to your tax professional so that you can understand if this is a good time for you to do the conversion. You can always do a conversion on December 31st and technically on January 1st, although this would probably be something we would want to see you do in December, and then at some point in January, and then ultimately you would be splitting that tax bill over 2 years, and you can do that fairly close together so that if you're converting an asset and you do have to have a fair market valuation done, then you would only need one as long as it was done within 30 days. And don't forget, the deadline for Roth conversions for that tax year is going to be December 31st. And also keeping in mind that a lot of people are handling tax situations in December. And so working with your Advanta IRA representative to make sure you're getting that done, and so that we get all the paperwork prior to that December 31st deadline. And that's a big thing because, you know, if you reach out to us on December 27th and say what is needed, you may have a difficult time finding, for example, a property appraiser that is going to help you get the value of that asset prior to December 31st. So don't wait, reach out to us now and be aware of what you might need if you're planning on waiting until December to do that actual conversion. And also, I just want to point out that it doesn't necessarily matter if you're going to do the Roth conversion, you know, for 2023, if you do it now versus in December, because it's going to be for the tax year of 2023. And the only time I guess it would really matter is depending on what the value of that asset might be now versus at the end of the year, and whether or not it's inflated now or would be inflated at the end of the year. So keep that in mind. I had another question pop up. If I convert to an existing Roth, does my converted? Yes, the converted money always has a 5-year clock because the new conversion has to age for 5 years independent of the Roth IRA. So every year that you do a Roth conversion, that newly converted amount has its own 5-year aging. And we're at the end of our webinar here, so I just wanted to go over a few things with you guys, and you can continue to put questions into the question box and I'll address those before I close out. We have classes going on and events all the time, and they're always no cost, no obligation. We have seminars and webinars, we have networking events, and actually we haven't hosted anything live in our office, but we are going to start probably towards the end of this year. And so if you have attended something at our offices or something that we do out in the community, we probably haven't seen those in a long time, but we're talking about getting those started again towards the end of this year. Our webinars are typically twice a week, so we also have one this week on Thursday. You can check out our events page, Advanta IRA AdvantaIRA.com/events for all of our webinars. We also have a Zoom networking event. We call it Pitch, Promote, and Prosper, and it is taking a break for the summer, but we will be back with Pitch, Promote, and Prosper in August, and we hope to see everybody on that event. We have a video library where we archive all of our webinars, so you're welcome to check that out. You can also search us on YouTube and find all of our videos there. And we have a blog article where we update that with everything important to the industry, including IRAs in general. So it might not just be specifically about alternative investments, but IRAs in general as well, things like Secure Act 2.0. And anything that you might see in the news, we try to keep up to date on our blog as well. Here again is my contact information. So if you had a specific scenario that you wanted to discuss with me, or if you wanted a copy of the slides and you were not able to download them out of the handouts box, you are welcome to email me. My email address is here on this slide. And let me just check the questions. I did have a question pop up about events in the Atlanta area. Yes, once we start scheduling events again, we will do them both for our Tampa Bay area office in Florida as well as in the Atlanta area. So thank you for that question. And then we also would potentially do some events in North Carolina as well. So we have a few locations there that we would be looking at, and we will let you guys know. They will be sent out to you depending on your location, or we do our best anyway. So if we don't necessarily have your city and state on file, then you can always check our events page because everything gets posted there. I don't have any other questions popping up, so I just wanted to thank everybody for attending today's webinar. I hope you found it beneficial. If you have more questions for me, again, please feel free to reach out to me. My phone number and extension are here, as well as my email address, and I look forward to having everybody on our next webinar. Thank you.